As economic turmoil grows in the U.S. amid the COVID-19 fallout, insurers looking for additional funds to help offset liquidity pressures may turn to the Federal Home Loan Bank. I'm John Weber for AM Best TV. Here to discuss a recent report on the subject is Jason Hopper, an Associate Director in the Industry Research and Analytics Department at AM Best Rating Services. And Jason, what are some of the dynamics behind borrowing from the Federal Home Loan Bank, and how widespread is FHLB access to the insurance industry?
Hi, John. Thanks for having me. So not just anyone is able to borrow from the Federal Home Loan Bank. Companies must own capital stock within it to be able to access borrowing funds, and capacity is determined by a mix of collateral and assets. Insurers have been using the FHLB for a long time to varying degrees, and as of year-end 2019, there were 471 insurance members, which was a growth of about 8% for the year. However, FHLB access is not substantially widespread throughout the industry, as only 22% of life insurers, 6% of property casualty, and 3% of health insurers actually have access to FHLB borrowings.
Jason, have you seen borrowing increase in the past couple of months?
Anecdotally, we have, based on a limited number of conversations with a few of the branches. I do note that demand and volume does differ from branch to branch. So the branches that we talk to may experience different volumes than some other branches. But in any regard, based on the branches that we have talked to, life insurers have been comprising the majority of the new borrowed funds. And to that end, 41% of life insurers have not used any capacity at all. So obviously they have a lot more available that they can tap if needed. And along with that, 71% of property casualty and 52% of health insurers have not used any of their borrowing capacity. Conversely, about 7% of life insurers have maxed out their borrowings, meaning that they have no more available funds to tap. And this compares to 3% for property casualty and about 12% in the health space.
Now, do we have any idea of how the use of the Federal Home Loan Bank breaks down between the major U.S. insurance segments?
Sure. The life insurance sector comprises the large majority of borrowings, which has continued to uptick in 2019. Life companies make up about 80% of total insurance industry borrowings, with health and PC comprising the remainder. Historically, life insurers have been using FHLB borrowings as more of a spread play, where they borrow funds at a relatively low rate, invest those funds at a higher rate, and make money off that spread. However, what we've seen in the more recent borrowings, life insurers have been using it more of a spread play. They've been using it more from liquidity trades, similar to historically what the property casualty and health companies have done.
Jason, are there levels or types of borrowing that would be a concern to AM Best?
Sure. So life insurers, the majority of their borrowing has come through funding agreements, which I said are used more for spread plays. And funding agreements have made up 82% of FHLB borrowings at year-end 2019 for life insurers. So from a leverage standpoint in treatment at AM Best, we view funding agreements, or they qualify for operating leverage treatment if insurers demonstrate strong asset liability management and liquidity management expertise. Credit is given for operating leverage, or credit for operating leverage ceases once the sum of activities qualifying for operating leverage exceed 30% of consolidated liabilities, excluding separate accounts. But in any regard, AM Best will continue to analyze FHLB borrowings and operating leverage on a case-by-case basis to determine the leverage treatment and the appropriate risk charges as applied to our BCAR model.
Thanks, Jason.
Thanks, John.
That was Jason Hopper, an Associate Director in the Industry Research and Analytics Department at AM Best Rating Services. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.